A big welcome to another Outcome Matters session. Now, the word outcome matters says so much. That's what we're obsessed with in terms of giving our clients what they need. But knowledge matters. This is what today is all about. Today, the incredible investment team and all the expertise we have there are going to give you all the insights, all the reasons, and all the even excuses in some instances, where and what you need to say to convince the people of this amazing strategy of outcome-based investing. And therefore, you need to actually embrace the knowledge and expertise of each of these individuals, which they're going to share with you. I just want to thank Investments once again for their amazing commitment, giving us our model portfolios and focus on us so that we actually becoming an agency that stands out in terms of what we give our clients. And yes, today we've applied also for CPD points, and you will actually note that there's a place where you can actually add your ID number, our FSP number, and then also the CPD section, and please go and do that, because otherwise you would not actually get the points needed. And then, very important, as much as this seems to be, a broadcast, you have to participate, and there's a Q&A capability there. So you can ask questions, you can actually, post anything. And more so even, I think the investment team might just deserve a couple of compliments on that platform. So enjoy it and actually make sure that you embrace the knowledge you gain from this and insights so that you can be even better in terms of what you give your clients. Thank you very much for attending, and thank you, Investments, for the great partnership with yourselves.
Good day, Momentum Financial Planning. Although 2021 is not quite over yet, given that this is our last session for the year, it might be good to reflect on the year so far. The headlines and reflections for the last 2 years will have COVID-19 listed in the record books across the globe. However, COVID-19 is not the only challenge we have had to face. We also had Brexit, Trump's impeachment, and closer to home, we witnessed acts of violence and looting, which engulfed our nation. There are many negative sentiment, and they continue to make news headlines. Having said this, there's also no better time to look at optimistic moments, and closer to home, we had a few of those. Momentum Investments had a stellar financial year, with the wealth platform breaking historical records. The new business that our advisor partners entrusted with us is almost 40 billion rand. In our history, we have never seen support like this. Furthermore, MFP was an important supporter and partner to this success story, having brought in a staggering 9.2 billion rand. We have also seen record-breaking support for our guaranteed life annuities, with MFP supporting just over 1 billion rand into this product line, a solution that really offers clients certainty and predictability in these turbulent times. I would like to take this opportunity to share an interesting piece of work we have conducted to reflect the year in review. We asked our BI team to summarize some of the statistics for us, where we reflect on how we actually touch the lives of our clients. We focus here on the quarter that ended 30 September 2021. We paid an income of almost 400 million rand, and this was to 51,000 clients within MFP. We enabled 100 clients to retire with a value of 37 million rand within MFP. The investment return provided by Momentum Collective Investments to MFP clients was 127 million rand, and the equivalent return from MIC to MFP's clients was 111 million rand. I am sure that you will agree with me that these results prove that we are making investing even more personal. I know that at head office we don't always seem to appreciate the day-to-day engagements that you as advisors have with your clients, but these stats made it real for me and our team. With us, investing is really personal. And the partnership between Momentum Investments and MFP was further strengthened by reaching one of our most significant milestones as we launched the in-house solutions Houseview, as well as the model portfolios dedicated to MFP. We collaborated with MFP while developing these solutions, and our outcomes-based philosophy allows us to make a direct link between your advice process and the MFP HealthView solutions. Let me provide you with a few key updates on the HealthView since its launch. Our team had numerous engagements with a large number of MFP advisors to explore the HealthView and how it can form part of your advice process. The number of supporting advisors has increased from the launch in April 2021 from just 15 planners to now more than 70 planners. The net flows since the launch is 230 million rand and the assets under management is almost 250 million rand. As you can see, the green shoots are certainly there, but there is still some work to do. I want to encourage you to engage with our fund specialist team members to discuss any questions you might have on these solutions. Now let's look at the important information pertaining to the unit trust range. We have seen a positive inflow to our Momentum Flexible Income Fund, which proves that our partnership with you has yielded positive results, and through your continued support, we are sure that it can only get better from here. Now at this point, you are probably thinking that I'm going to pause and start talking about the plans for the new year. Not at all. I am proud of the plans that have been made in our partnership with MFP. It's a case of continuous effort in supporting this key initiative. Now that I have showcased the latest available information, it is at this point that I would like to take this opportunity to really thank each one of you for your support. I want to emphasize that this partnership with you has been founded in true collaborative spirit between our businesses. Every partnership starts with getting that foundation rock solid, and I believe we have achieved that. It's now time to put the advice process and fund house view into your day-to-day engagement with clients and between the MCI and MIC team. We remain committed to you as MFP. Ultimately, we have the same goal in mind, to provide our clients with a better investment outcome and to therefore support them on their journey to success. Thank you for your continued support this year, and thank you for your contribution to our success story. Enjoy the specially tailored investment update in today's Outcome Matters.
Good day. Today we are going to discuss the developments in the fixed income markets. We'll start off with what does that world of fixed income look like? You know, a lot of discussion around the Feds, the ECB. What does it mean for South Africa? And then we'll move to the South African fixed income markets. We'll start with the money market. What is the market pricing with the SARB? What is the SARB going to do? Then we'll move to that hot pot of South African fixed income called the credit market. What are we seeing with corporate issuance? And then we'll move up the curve and we'll say, well, what's happening in duration assets? We'll talk around nominal bonds. We'll talk around inflationing bonds and what's the valuations and what's the attractiveness of those asset classes. And then we'll end off with the expected return. So what can our clients and our investors expect from fixed income over the next 1 to 3 years? But first, over the last 2 months, let's have a moment of silence for bond markets. It's really been a tough time for them. But anyway, let's move on. The biggest issue at the moment globally is what is priced in the US market for Fed hikes. So remember, the Fed did 2 measures of stimulus. Firstly, there was the cutting of rates down to 0.25%. And the second part was this buying of assets of government bonds and mortgage securities, $120 billion a month. Now they've pulled it back. Now it's going to be like 105, and the next quarter it will probably be around 95. But that does not mean that rates are going to go up in the US soon. What the market is pricing is that, yes, the Fed will pull back on all these purchases, but then somewhere around the end of 2022, 2023, the market is pricing, look, then the Fed will probably have to pull the trigger and hike interest rates. But what does it actually mean for bonds? So let's go back in history. So we saw what we call a taper tantrum in 2014 when the Fed announced that it will pull back on its purchases, but the bond market didn't react. It actually took 2 years for government bonds to react. We think it will be very similar in the current environment where the Fed has announced last night that it will pull back on stimulus, but bonds may only react in 2022 or 2023. It's not an instantaneous movement bond markets will wait and see what is actually priced, what is that rhetoric from the Fed going forward. This is the US yield curve, quite important. Remember, yield curve is the term structure of interest rates in the economy. The current yield curve is the green line. So what we've seen, it's moved from the blue line to the green line over the last year, saying that the heightened inflation numbers plus the expectation of interest rate hikes from the Fed means that interest rates are going up in the US. And the second movement is what we're seeing is what we call a flattening of the curve, meaning the front end is moving more than the long end, saying that inflation is going up in the US and the Fed better start looking at hiking rates. So the market is running a little bit ahead of the Fed. When the Fed says inflation is transitory, we're not going to hike rates yet. We are not too concerned around inflation. What is priced is a growth concern. As we probably know now that the Northern Hemisphere is in the midst of the fourth wave. We've seen a lot of new infections. And that means that there will be a hit on growth, slower growth in the Northern Hemisphere. And that's why it says, the Fed says, look, we can't hike rates now. We've got to wait for 2023. Otherwise, if we hike rates too soon, the economy slows down, then we've got to cut rates again. So they don't want this stop-start effect in monetary policy. They actually want to say, we want to have a very measured way that we're withdrawing stimulus from the US economy. Now, this is a graph that's quite important. We call it the US 5-year forward break-even. Wow, what a long name. But what it actually means is, where will inflation average in the US over the next 5 years? Now remember, the Fed says it wants to keep inflation below 2% on an annual basis. Yet, headline inflation in the US is around 5%, more than double the target of the Fed. And the market says, look, we think you, the Fed, will not be able to contain inflation. So we're saying that inflation over the next 5 years is going to be 2.4, 2.5%. You will not be able to control inflation. So there's this dislocation at the moment in the global market, saying that the market sits on the one side and the Fed sits on the other side of the debate, and who will be right? Well, we don't know. Only in the fullness of time will we know, is the Fed correct, or will inflation actually be structurally higher for longer and the market is correct? So what do people do? When you're worried about inflation, what do? You buy inflation bonds. In the US, it's called TIPS, Treasury Inflation Protected Securities. So are you then surprised when these assets run hard? So their yields fall quite a lot. But the worst is they're actually negative. So you actually have to pay somebody to buy a bond. Can you believe it? 10-year US TIPS is trading at minus 1%. Can you believe it? That's how scared some investors in the market in the US is about inflation. They're worried about a 1970s style inflation. Now, we don't necessarily believe that that's the case, but it says to you where that fear trade is in the US at the moment. So what's happened with developed market bonds? Exactly what we're saying. So remember, the Fed sets the base rate for global interest rates. So now there's fears that the Fed might be behind the curve. They may need to hike rates. We're starting to see the Bank of England saying, look, we're worried about our inflation target. We might need to hike rates. So all these bond yields are lifting, meaning the prices are falling. And that's why I said to you, let's have a moment of silence for bonds, especially over the last 2 months. September and October has been poor months for bonds globally. Why? Because we're moving from that bottom of the interest rate cycle to higher interest rates. Over what time frame? We don't know, but it clearly says to us that bond markets are worried that inflation is more structural and that the central banks will have to react at some point in time in the near future. What really set the cat among the pigeons was China. Now, we all know about the high debt to GDP ratios in developed markets, and we all hear the 260% in the US and the 300% in Japan. I think we keep on forgetting that one of the most leveraged economies in the world is China. Debt to GDP ratio of about 350%. Can you believe it? 3.5 times more debt than the GDP. So it says to us, China is an emerging market. Remember, it's not a developed market, and it's 3.5 times levered. So there's huge credit risk in China at this point in time. And the market has started to work out. Because remember, when interest rates go up and central banks lift interest rates, the price of credit changes. And we've seen it in China. two things. So the price of credit is moving up, the cost of capital is moving up, and the higher risk of defaults. Because as the cost of capital moves up, so does credit risk. And that's exactly what we're seeing. So in China, your high yield market is moving up, the blue line at the bottom, quite a lot, right? So it says, we are worried that there could be defaults in China. And that's exactly what happened. Evergrande couldn't pay its coupons on its bonds, basically defaulted, right? And suddenly we saw China credit blow up, emerging markets came under pressure, the rand blew up, commodities took a hit, the dollar got stronger, and investors ran into the safe havens of US treasuries, German treasuries, European bonds, Japanese bonds. And that's exactly what happened. So there's a risk in China. And that risk may not go away. So we know now that Evergrande is paying the coupons on the bonds, but we also know that there's other property stocks in China that's at risk of not paying the bonds or the coupons. So watch out for more defaults in that part of the world. Right, so what about our own bonds? We are emerging market high yield, so think about us, ourselves, Turkey, Russia, Brazil, Mexico. We in that little group in the world. So we saw developed market bonds move up. So why would it be different for emerging market bonds? We'll follow that trend, and that's exactly what happened. But also remember that the central banks in these high yield countries have been very hawkish on inflation. They have high inflation, and the central banks have been hiking rates aggressively. Turkey, Brazil, Russia, they've all been hiking rates. South Africa, the green line, we've not hiked rates, but we're getting closer to that point. So there's quite a debate going on what the SARB will do or won't do. So does the SARB have FOMO, fear of missing out and not being part of the hiking cycle, or not? Right, so we are in this bottom cycle of interest rates and we are going up. So what does the environment now look like? If we look at the cash markets, now remember this is the front end of the curve. This is what we call the funding curve, where the SARB actually has the most leverage, where it hikes rates. So obviously the repo rate is very flat at 3.5%, but you can clearly see that your bank funding rates, your money market or your NCD rates and your JIBAR rates are going up. Why? Well, inflation in South Africa is 5%, so we've had higher inflation over the latter part of 2021. And the second part is the market is also now expecting the SARB to hike rates, right? So that is the reality. So when those two factors converge, interest rates go up. So what are we seeing? So we're seeing still a very flat money market curve, but the long end moves higher. So your one-year rate sits probably around, call it 4.60%, and your three-year rate closer to 6%, and your five-year rate at 7%. It says to you, interest rates are going to be flat, and then suddenly it's going to move higher over the next 2 years, right? So that is what the market is expecting, that interest rates will go up. But how fast will they go up? Now that's the big key. So there's quite a lot of debate going on saying, look, the SARB has to hike, and it has to hike by 25 basis points or 50 basis points in November, and then it will go January and March, and it will just not stop hiking. We say the market is probably getting too oversold at the moment. There's quite a convergence of views that the SARB will just go into a very aggressive hiking cycle from November onwards. And if we look at the total picture, it says, well, the market is priced that the SARB will probably hike 300 basis points of rate hikes over the next 2 years. And we say, whoa, we just think the market is getting carried away here. Yes, the SARB will go into a rate hiking cycle. And I think in our mind, in our team's view is, I think the jury is still out if they will really hike in November. What we do say is we do believe that they will start hiking from that first quarter. So let's say somewhere between the January and March meeting of 2022, but slowly. This is not going to be 3% of rate hikes over a 1 or 2 year period. We say, well, remember the South African economy is only recovering out of COVID. You can't just hike rates dramatically. There's going to be a time period for interest rates to go up. So we say, well, the market is pricing too many rate hikes. We think that interest rates will probably go up over the next 2 years by around 75 basis points in 2022, another 75 basis points in 2023. So the repo rate will probably end up around 5% by the end of 2023, not a 6 or a 7% repo by the end of 2023. So the market is pricing for a lot of negative news. But it's in these markets that we find opportunity. So if we move to the hot pot of South African fixed income, it's the credit market. Now, in this market, we are struggling to find opportunity. Why? Because assets are very expensively priced. So if we look at this listed credit market in South Africa, It looks like we're going to have about 100 billion of issuance this year. So a big recovery from the 60 odd billion that we had in the previous or the first part of the year. We're going to suddenly get to 110 billion of issuance this year. So remember, a lot of corporates were very afraid in 2020 to come to the market and put more debt on the balance sheet. This year, they obviously feel a lot more comfortable, and we are seeing a lot more issuance into this market. So a lot more credit issuance. So it's not about the issuance number. The problem that we see is the pricing. So what we're seeing is that prices are very, very high in this market. So what usually happens is, remember, credit trades at a spread above an interbank rate or above a government bond rate. And what we're seeing is that these spreads have narrowed quite a lot versus the interbank rates. So the prices have gone up quite a lot. And you know, as I always say, we are valuation based. And it's when prices are high that we struggle to find opportunities. When prices are low and yields are high, we find good opportunities. So in the credit market at this point in time, we're not finding a lot of opportunities. Why? Because all these graphs are downward sloping. Downward sloping means the prices are going up, the yields are lowering. So it's very hard for us to find good opportunities in this market, and we are finding less and less opportunities in this listed rated market, and we need to go and hunt in other markets, the unrated market or the unlisted market, for good opportunities for our credit funds. So let's go to the more interesting asset classes, government bonds, right? I've been standing on this platform for probably more than 2 years saying that we think South African government bonds is probably, on a risk-adjusted basis, one of the best asset classes to invest in for investors. Why? Because they are so cheap. So what we have seen over the last 2 years is what we call, firstly, a curve steepening, when the SARB cut rates by 300 basis points and the front end fell away and the long end went up. This year, we've obviously seen the inverse happen, where the market is pricing the SARB will hike rates in the front end and that inflation is going up. But because of better fiscal policies, right, it says, well, the long end shouldn't price at such a huge premium. So we've seen the long end come in. So the South African yield curve is still very steep. So the front end sits around 4% and the long end sits around 10.5%. And we say to investors, why sit in that 4% front end of the curve when somewhere in the, call it 10 to 20 year area of the curve, you can have yields of 9.5 to 10.5%. We think there are very good returns for investors over the next 2 to 3 years in South African bonds, generating very high returns on a risk-adjusted basis. But what's happening in this bond market at the moment is, unfortunately, it's a very South African-orientated market at the moment. Why? Because foreigners are selling South African bonds. Just like equities, they want to get out of emerging markets. When they hear the Fed is going to hike rates, when they hear other central banks want to hike rates, they say, well, look, we want to take risk off the table. We don't want to be in South African bonds. So yes, the numbers look big. It's the best JSE data that we can get. But what it's saying to us is that the South African bond market at this point in time is actually being bought by the South African investors. And we've actually seen foreigners take a very high holding of about 38% of South African bonds to around sub 30%. So foreigners are getting out of the bond market. So what we have seen is that foreigners are sellers of South African bonds to the tune of around 100 billion. And that local banks, asset managers, insurers are buyers of South African bonds. And it's usually a good sign to us. Foreigners get out. That means that prices are falling, yields go up. It means there's good opportunities for South African investors in our local bonds. If you're concerned around what is happening in the globe with inflation and the central bank can actually hike rates, what is the alternative asset class that you can go to? It's actually inflation bonds. Now, I've shown you the volatility of the nominal bonds, right? And it moves with the currency and inflation and prices. But our inflation bonds have actually been very stable. So in a world of volatility, inflation bonds actually look like a very attractive trade to us if you're concerned around currency volatility and what could happen to the SARB. So we add them to our portfolios as in what we call the non-correlated trade. We like inflation bonds, we like the duration, we like the 4.25% real yields that they actually present to our investors. So also one of our preferred asset classes in fixed income. What does this curve look like? So 2 or 3 years ago, real yields in South Africa was probably around 2.5%, 3%. Now the green line that you can see is where our what we call our real curve or ILB curve sits. And you can clearly see, yes, once again, that front end sitting at 1 or 2% is not that attractive to us. But that long end sitting at 3.5% to that very long end sitting at, call it 4.5%, that's very attractive to us. Somebody's saying to you, look, you can take government risk, get a real yield of around 4.25% and not worry too much about rand volatility, we think there are good returns for investors over the next 2 to 3 years in this asset class. So to end off, we've painted this picture that the global environment for fixed income is changing. In South Africa, let's put the peg in the ground. Inflation is probably going to be around 4.5%, and growth is probably going to be around 1.5%. So not exactly shooting the lights out. So if you sit in cash, you're going to get this 4.6 maybe to 5.5% type return out of cash. Not really that attractive, and then you've got to pay fees. So we say it really doesn't make sense to sit in cash. We talked around the credit market, which is really a hot pot. So yes, you can take a little bit more risk and you'll get this 5 to 6% return. But yes, you'll take a fair amount of credit risk. Our two preferred asset classes remain nominal bonds and inflation bonds. When inflation is 4.5, growth is sub 2, you're sitting with 10% yields in 10 years. We think it's not a stretch to get 8.5, 9% returns from nominals and inflation bonds at a very low risk level. So let's put the peg in the ground then. Inflation at 4.5%, growth not even 2% over the next 2 to 3 years. Our preferred asset classes still remain inflation bonds and nominal bonds. Why? Because you clearly see that if inflation is around 4.5, we can get 8.5 to 9.5% type returns from these asset classes. So over the next 2 to 3 years, we definitely want to remain long duration, long convexity, and generate that steepness out of the yield curve for our investors without dialing up the risk. And that's why we say that nominal bonds and inflation bonds remain our preferred asset classes in fixed income and will remain overweight duration and convexity in these funds for the benefit of our investors. Thank you.
Good day, and welcome to our quarterly update for the Momentum Focus Fund of Funds. In today's session, Ronnie and I will use this opportunity to give you a brief overview in terms of what transpired in markets over both the past quarter as well as the last 12 months, and how those events impacted our thinking in terms of portfolio positioning as well as delivery. We trust this update will also assist you, our partners, in having those crucial conversations with your clients. We've experienced a period of extremely loose or accommodative monetary policy, whereby central banks have embarked on unprecedented levels of monetary and fiscal policy measures. These measures, whether in the form of lower interest rates, Reserve Bank purchases of financial instruments, concessions, subsidies, or even infrastructure spending, was intended to keep markets liquid and operating as smoothly as possible. Even on an individual level, it was intended to put money back into people's pockets. Cheap money and accommodative policy paved the way for what we experienced over the past 18 months. We've experienced not only a strong global economic recovery, but also a very strong rebound in especially equity markets. From an economic perspective, global growth has been underpinned by these initiatives, as well as a gradual reopening of economies, although vaccine hesitancy and new variants may still prove to be the major risks to this recovery. More recently, we've also seen stronger signs of inflation coming through the system, with the US inflation rate breaching the Federal Reserve's target. This has created some anxiety with investors, but we still believe this is expected to normalize to some extent over the next 6 to 12 months. Adding to some of the uncertainty has been somewhat disappointing growth numbers reported in China, impacting commodity prices, and we witnessed a near collapse of Chinese real estate firm Evergrande, sending jitters through the market. All this culminated in increased volatility, something we have to manage and monitor over the next few quarters. Turning our attention and focus to the local economy, it certainly has not been one-way traffic either. We have seen economic growth for Q2 2021 surprise to the upside at 1.2% quarter-on-quarter annualized, and this compares favorably to consensus of 0.7% quarter-on-quarter. In addition to this, we've experienced a strong cyclical economic recovery. Despite the strong start, there is some concern that low vaccination rates may pose some risk to a continued opening of the local economy. especially as we move closer to the festive season and summer school holidays. Recent unrest has unfortunately proved to be a headwind to growth and stability, along with the spiking third wave of COVID infections. On the inflation theme, inflation in SA is still well within target, but it is creeping higher over the shorter term, as especially petrol prices continue to surge higher. When looking at how the economic backdrop impacted market returns, it is not surprising to see a strong equity market recovery. South African markets broadly ended the quarter in positive territory, despite what was a difficult and volatile month in September. Equities and bonds struggled in September, following renewed concerns regarding inflation, especially in the US, and financial stability, as we witnessed the near miss with Evergrande. Quarter 3 returns followed that of a few very strong preceding quarters, building up to what has been a very strong 12 to 18 months for investors. Traditional growth asset classes, including nominal and inflation-linked bonds, also posted pleasing returns over the past 12 months. On the global front, both equity and property asset classes continue to fare extremely well, especially for SA investors, where the rand's 5.4% depreciation against the dollar added to global investment returns. Delving into a little more detail over the past 12 months, we can clearly see what the drivers of local returns were. Financials turned out to be the strongest subsector within the equity market, as especially local banks posted significant gains, buoyed by a combination of attractive valuations, resilient balance sheets, and a generally better than expected COVID provision experience. Resources, on the other hand, lost some momentum of late, given the economic conditions described earlier, although some supply constraints are still evident. The sharp increase in oil prices, however, did benefit some local counters, especially Sasol. ILBs had a very strong 12-month performance, yielding nearly 16%. This was mainly driven by rising inflation and a further decline in real yields. Nominal bonds delivered a stellar performance, also over a 12-month period, returning 12% as the yield curve continued flattening. The strong performance in the first 6 months of 2021 was halted in the third quarter as nominal bonds sold off, and the ALB delivered negative returns. Following a series of aggressive interest rate cuts in the early part of 2020, it is not surprising to see that cash is again yielding a negative real return. While this is not the first time this has happened, it does end a period of 5 to 6 years where investors earned a significant real return at very low levels of risk. It is therefore an important aspect to consider in future planning and investment decision making, as the relative ease of moderate returns at low levels of risk is seemingly at an end. We have for some time discussed and demonstrated the tough times that traditional growth asset classes experienced. And with this chart, it again demonstrates the inability of especially local growth assets to outperform cash. The picture has, however, shifted quite considerably over the past 12 to 18 months, where investors were once again rewarded for taking on additional risk. While the pace of economic growth and earnings are seemingly slowing down somewhat, we still believe that the growth underpin of accommodative policy and the relaxation of movement will continue to support these asset classes. The recovery in financial markets have been very relevant for our solutions, as we experienced an exceptionally strong 12 to 18-month period post-COVID. And we are seeing a similar trend playing out in the market. While it explains the turnaround of multi-asset class fortunes, we are not out of the woods just yet, as we can clearly observe the average fund in the various CISA categories still not delivering significant CPI-beating returns. Turning our eye to the future, we believe the growth underpin will be sustained, and with it, we'll continue to see good investment opportunities present themselves across the equity spectrum, both locally and globally. There is no doubt that some segments of the market are better priced than others, and we therefore have confidence that the multi-strategy approach adopted in our portfolio construction process will both capitalize on these opportunities and cushion against some of the volatility and variability in equity market outcomes. As mentioned, we continue to see good opportunities in the domestic fixed income market, where selected nominal and inflation-linked bonds offer value. As was discussed previously, we remain cautiously positioned in terms of our local property exposure, as fundamentals related to vacancies, revaluations, and escalations remain challenging. What a difference a year makes. The last 12 to 18 months make for much better reading. Turning our attention to the more recent portfolio and performance experience, Ronnie will now give us a sense of how the funds have performed, the drivers of portfolio returns, and very importantly, the portfolio actions taken over the more recent investment period.
Thank you, Yaku, and welcome to everybody dialing in today. I'm happy to report that despite markets taking a definitive breather in September, which essentially wiped out all the earlier gains made during July and August, our multi-asset funds added positive returns of between 1.6 and 2.6% over Q3, depending on the risk profile, of course. 12-month returns for the funds to end of September currently range from 16.4 to 22.6%, and the funds remain comfortably ahead of both their strategic benchmarks as well as the applicable ASISA peer group average. The main asset classes and positions that drove these double-digit returns have been our ongoing exposure and tactical tilts to local and global equity, SA nominal and inflation-linked bonds, and to a lesser extent, a moderate exposure to listed property. March 2020 now feels like a very long time ago, and I don't know about you, but I distinctly recall how uncomfortable it was, and the intense discussions we as an investment team had on a daily basis to navigate the funds as markets kept on sliding. I can also appreciate that clients and you as their advisors must have had a similarly nerve-wracking experience, with the human urge to just want to do something, also known in the behavioral finance circles as the action bias. In the end, we did reposition the portfolios for the prevailing market conditions and risks, careful not to take too much risk off the table. Any additional de-risking actions by investors stood the chance of doubling down, so to speak. Looking at performances to the end of September, the funds have participated handsomely in the recovery, and their cumulative returns since the COVID-induced sell-off have outpaced their respective ASISA multi-asset peer averages by between 4 and nearly 8% in the past 18 months, proving once again that staying invested is the best strategy. Now, these high absolute returns have partly been a function of the ongoing market recovery, but also our hands-on active management approach. Considering the fund's investment delivery over the longer term since inception, we can also see that it is reflective of our philosophy and approach to deliver real inflation-beating returns by remaining invested with sufficient growth asset exposure through a difficult market cycle, as we experienced early on in 2020. If we take a look at the delivery of the constituents that make up the Focus Fund of Fund range, we can see that over the recent 12 months, domestic growth assets lagged marginally, while the fixed interest assets outperformed their benchmarks. Our active global equity funds benefited from the strong value rotation seen earlier in the year, with manager Contrarius, for example, delivering as much as 119% in US dollar terms over the 12-month period. During Q3, the global emerging market component in the fund outperformed its benchmark. However, it was still strongly negative as China continued to slide, dragging the MSCI Emerging Market Index down. Our Global Fixed Income Fund, which also happens to be our largest underweight position, also ended the year slightly behind benchmark. And that was perhaps one of the easier calls we've had to make in a while. Now turning our attention to the recent 3-year window, we can really see the strength of the domestic multi-asset equity blend coming through. The impact of the sell-off early in 2020 is, however, still permeating through the flexible fixed interest fund's 3-year returns. But as we saw in the previous slide, this fund, which generally takes a longer-term view, has already staged a strong recovery and is currently well positioned to take advantage of the fixed interest market climate. Our colleagues in London have unfortunately also had a challenging 3-year performance cycle in terms of global equity, as the value style and small to mid-cap bias of the fund struggled to keep pace with the mega-cap, tech-dominated MSCI World Index. As I've alluded to earlier, the domestic equity blend in the fund, which we construct to outperform the index on a rolling 3-year basis, has been a significant driver of consistent alpha in the fund range. The recent spike in cross-sectional volatility, coupled with the knock-on effects from the Chinese government's clampdown on tech, as well as concerns over China's growth prospects and a stumbling commodity sector, has dampened short-term returns. We do, however, remain confident in the positioning and actions of all the underlying managers in the blend. In this next chart, I want to demonstrate the diversification and breadth of the alpha delivery over both the short and longer term in the local equity manager blend. Once again, I want to emphasize the importance of deliberate diversification across value, quality, and momentum risk factors, coupled with manager diversification that we target. Fairtree, who has been one of the strongest performers over 3 years, detracted during Q3 as a result of their precious metal exposure in particular, while Prudential and Truffle outperformed off the back of financials and small cap buyers, as well as being underweight to Naspers. Given our resources have bounced back strongly in October, this volatility would have been a great buying opportunity for our resources bulls, while complementary strategies have balanced out the overall returns in the blend. In terms of positioning, we maintain a pro-growth stance, but we do think returns may be a bit harder to come by in the coming months. We have tactical overweight tilts to local and global equity, as well as domestic and inflation-linked bonds. We remain cautious of local property based on the sector's outlook, but we have, however, been adding to our global property positions throughout Q3. The outlook for global fixed income remains unattractive and is reflected in our sizable underweight position. Similarly, on a real return basis, cash is not currently very rewarding, but we are building some positions to take advantage of buying opportunities in risky assets. We are therefore very happy with the way things have progressed over the past 18 months. But as you know, there is always more work to be done in these ever-changing market dynamics and circumstances. One such initiative involves the creation and launch of the Momentum Future Trends Fund, which will be incorporated into the Focus Fund of Funds. Let's hear what Jaco has to say about that.
Thank you, Ronnie. Indeed, as you mentioned, it is important for us to continuously evolve in our portfolio management thinking and improve investment delivery for clients. On that note, I'm very excited talking about the inclusion of our Future Trends strategy, this into the Fund of Fund range during the first quarter of 2022. We have done an enormous amount of work in identifying 6 megatrends that will shape the future of this evolutionary world. And this strategy will serve as a diversified exposure to our existing global equity strategy. As the curtain comes down on yet another eventful and interesting year, I trust that today's overview has been both informative and insightful, and that you as advisors are well equipped to have those important conversations with your clients as it relates to the advice framework. We thank you for your time and attendance, and until the next time, please take care and stay safe.
The stock market can remain irrational longer than you can remain solvent. I'm sure you're all familiar with this famous quote by John Keynes, and given that stock markets seem to reach new highs almost daily, this quote perhaps resonates with some of you who have missed this unprecedented recovery. Taking the example of Tesla, whose share price has returned over 2,000% over the past 5 years, and whose market cap is now bigger than almost all the Western auto manufacturers combined. I'm sure there are a few of our value-biased managers who have never held Tesla who can certainly relate to this quote. But herein lies the beauty of our outcome-based investing philosophy and multi-strategy execution. Within the MFP Focus model portfolios, whose performances and positioning we will be unpacking in this presentation, we employ a range of strategies within our equity allocations, including value, quality, and momentum. This multi-strategy approach ensures we have access to a broad range of investment theses, meaning we don't miss out entirely on massive rallies in the likes of Tesla. Before we continue, I'd just like to remind you that if you have any questions throughout the presentation, please feel free to post your questions in the Q&A. Before we jump into the MFP Focus model portfolios, I'd like to first set the scene and unpack the market backdrop since launching the portfolios in March 2021. Global markets entered the third quarter in much the same way as the previous quarter ended, with investor sentiment riding high on the recovery in global growth and strong corporate earning announcements. Despite sharply rising COVID-19 case numbers for much of the quarter, investor sentiment stood resolute. However, the tide would turn in September, with the quarter culminating on a plethora of risks which had been lurking beneath the surface but had largely been disregarded by the market. As fears grew around the possibility of higher inflation, tighter monetary policy, potential contagion from an increasingly worrisome Chinese economy, and the growth impact of the relentless COVID-19 Delta variant, global risk appetite expectedly diminished, and capital markets sold off aggressively, which dampened positive returns earlier in the quarter. Growth asset classes still managed to eke out fairly strong returns in the quarter, both locally and globally, with local property and local equity markets up around 5.9% and 3.2% respectively, while global property and global equity delivered returns of around 4.5% each, supported by a sharp weakening in the rand in September. Within global equity, developed markets significantly outperformed emerging markets, as the regulatory crackdown in China significantly impacted performance in the region. On the defensive side, the fears around global inflation, tighter monetary policy, and global growth drove bond yields higher, particularly in September. As a result, local bonds gave up earlier gains in the quarter to end flat, while global bonds were positive in rand terms, as rand weakness offset losses in the yield curve steepening. Finally, looking at the 6-month figures, that is since the launch of the portfolios, it is evident that this has been a very strong backdrop off which decent portfolio returns could be made. Diving deeper into local equity markets, the third quarter was almost a carbon copy of the second, as stocks tethered to the cyclical recovery narrative continued to outperform. Financials again led the charge from a sectoral perspective, while from a market cap perspective, small and mid caps significantly outperformed large caps. Within industrials, Naspers and Process continue to come under pressure as a result of the ongoing uncertainty in China affecting the Tencent share price. Resources also came under pressure as commodity prices sold off, with industrial metals impacted by the reduced demand from China amid a potential real estate crisis, while precious metals, PGMs in particular, were impacted by the global microchip shortage, which has hampered automobile production, thus reducing the demand for PGMs in catalytic converters. Looking at the balance of local asset classes, local property was again our best performing asset class, up around 6% in the quarter, despite its seemingly poor fundamentals. Local bond returns, on the other hand, painted a different picture this quarter, as the long end of the yield curve sold off more aggressively than the shorter end, in line with global bond yields. Finally, cash returned a meager 1%, as real rate interest rates remained close to zero, with the Reserve Bank once again keeping interest rates unchanged at its latest meeting. Now, turning to the MFP focus model portfolios, this slide shows how the portfolios have performed relative to their benchmarks and peers since their launch in March 2021. It is important to note that as these are model portfolios, we have used the most appropriate peer group according to where the funds would appear if they were registered collective investment schemes. Across the board, the portfolios have taken advantage of the positive macroeconomic and market backdrop, with all portfolios comfortably ahead of their benchmarks and peers, albeit over a very short period. Looking closer at our returns, this chart shows how the portfolios would have performed since their launch, assuming we invested passively and for free according to our strategic allocations. All local asset classes barring cash have been significant contributors to performance, while global equity was also a significant contributor. Just to reiterate, the contribution from local bonds is much higher in MFP Focus 3 model portfolio given its more conservative nature and therefore higher allocation to local bonds. Similarly, as we move up the risk spectrum, the contribution from our growth assets increases. This table gives greater insight into our tactical calls. Overall, our tactical calls marginally detracted from performance across the portfolios. The primary detractors across the portfolios have been our underweight position in global bonds, driven mainly by rand weakness in June and September in particular, while our overweight to local bonds also impacted portfolios in September. These have, however, been marginally offset by our overweight allocation to global equity, given the continued rally in developed markets. Finally, this table shows the top 3 and bottom 3 contributors to alpha from a manager selection perspective. Given the different weightings in the portfolios, you will notice that the top and bottom contributors may differ from portfolio to portfolio. Starting with our contributors, despite the correction in local bonds in September, Momentum SA Flexible Fixed Interest remains a strong contributor owing to its outperformance last quarter, while Foort Equity is the top contributor, with the fund continuing to benefit from its significant underweight allocation to resources. Finally, Catalyst Flexible Property, who we rely on for both our local and global property exposure, has delivered strong alpha in both asset classes and has also benefited from their tactical allocations between the two. Our most notable detractors, on the other hand, are all within the equity space, both locally and globally. On the local fund, Fairtree has been the biggest detractor, owing to its overweight position in resources as well as Naspers and Prosus. On the global side, Momentum International Equities overweight to emerging markets and underweight to US equity hurt its relative performance, while Coronation Global Emerging Markets has significantly underperformed the emerging markets index, owing to their overweight to Chinese stocks in particular. Before we look ahead, it is worthwhile noting that as these are model portfolios and your clients get the benefit of seeing the underlying managers on their statements, and they may see notional losses when a particular manager's strategy is out of favor. We do expect that some of our managers outperform and some of our managers underperform, just like equity managers have outperforming and underperforming stocks. Given that markets reward different strategies at different times, we deliberately employ a range of diverse strategies to give your clients a more stable investment journey that is not biased to a single thesis or viewpoint. It is therefore important to remind them to focus on the holistic portfolio rather than a single underlying manager. Now, looking ahead, we still believe markets are poised to continue to benefit from the positive macroeconomic environment expected in the coming 12 months. However, we cannot ignore the growing risks in markets, most notably the potential of higher inflation leading to tighter monetary policy, the imminent start of tapering in the US, as well as the continued spread of COVID-19 and its impact on global supply chains, all of which we expect to increase volatility in markets. This table shows our portfolio positioning at a mandate level. This does mean that the actual asset allocations of the portfolios may differ slightly as a result of managers' allocations to other asset classes such as cash or global assets. As we said we would at our last presentation, we took the opportunity to marginally increase our exposure to local equities following the correction in September. With a relatively cheap valuation and strong earnings expected over the next few years, we are bullish on the prospective returns of the asset class over the short to medium term. Given the climbing risks in the global space, we have marginally increased our global exposure through the introduction of Coronation Global Strategic USD Income Feeder Fund. This protects us from a weakening currency in a risk-off environment and will help us to marginally offset any weakness in local bonds arising from rising global bond yields, while also avoiding the duration effect that would come from an increase in global bonds. We have also marginally reduced local bonds for this reason, although we remain marginally overweight given the compelling yields on offer. Finally, it is worth touching on our mandate allocation to local property being mostly neutral. Given the negative fundamentals plaguing local property companies, such as rising vacancies and falling rentals, we have a negative outlook on the asset class. However, because we execute via a flexible property mandate, we rely on the manager's skill and speed in navigating the tactical decision between local and global property, with the manager also having the flexibility to hold a significant cash position if they deem it necessary. While we are encouraged by the strong start to the portfolios, we know that it is a very short measurement period. With the risks we spoke about earlier still very much prevalent, it is important to understand that there will be turbulent times ahead, as this is the nature of investment markets. This is perhaps even more relevant today, as we've witnessed an unprecedented recovery in markets, pushing valuations to all-time highs on an almost daily basis, leading to some market commentators talking about bubbles in many places. Looking at this chart, which depicts the typical cycle of a bubble, it begs the question, where are we now? We can assure you that we are consistently applying our minds and keeping an eye on the global investment landscape to ensure that the portfolios are managed in such a way to give your clients the best chance of achieving their objectives. We therefore implore you to encourage clients to remain invested and allow us to navigate these trying times on their behalf, because with us, investing is personal.
Hello everyone, and thank you for joining me to talk about the very important link between our personality and risk behavior, and how we're going to make the lives of financial advisors just a little easier. A big problem facing advice for a number of years now is the relatively poor measurement of client risk preferences or tolerance, and interpreting exactly what this actually means. In other words, how do we use these insights in our advice conversations? This has likely resulted in questionnaires and assessments being completed as more of a checkbox exercise, deriving little value either for the client or advisor. Today, I'm hopefully going to convince you otherwise, as we talk about an important project underway to provide advisors with the ability to determine their client's financial personality, what this means, and how this can improve the advice proposition in managing a client's investment behavior. Let's perhaps start with the important dimension of someone's financial behavior. Traditional economic theory is great because it gives us a good idea of what the goalposts look like. Behavioral economics, though, explains why sometimes we miss the goals. Our decisions are off target by a little, sometimes by a lot, like even scoring an own goal. To help us explain our behavior, we need to look at factors that are more biological and sociological, as opposed to economic alone. This helps us to transfer economics to behavioral economics. Now, the reason is simple. The machinery we use to process information is very effective at processing primary rewards, like food and sex, for example. But when we use this very same machinery to process secondary rewards, like money, we often miss the mark or miss the goal. The diagram shows that if we want to understand financial behavior, we need to look at least three things. The first has to do with what is happening between our ears, and this is our neurobiology. Our brain has a reward system that releases dopamine. Dopamine makes us feel good when we do what our brain thinks is important for our survival. So, for example, finding and eating food feels good. But eating and binge watching a show on Netflix feels good too. And the dopamine released in this case is reinforcing behavior that is not always in our best interests. The most relevant side of the triangle we need to talk about today, however, is our personality, which of course is a branch of psychology. This is very tightly linked to our neurobiology. And the reason is simple, because in the nature-nurture debate, the jury is back and the answer is overwhelmingly nature. In fact, a recent study showed 9 areas of the human genome directly linked to anxiety. So being anxious sits in our genetic material that is, of course, inherited. The environment plays a mediating role for sure, but the blueprint, in other words, what we come with in our genes, is most certainly our factory setting. Let's zoom in on this concept of a personality. Luckily, we're at the point where scientists refer to personality theory as a normal science. So we actually do share a common set of beliefs about how this stuff actually works. Although the construct of a personality is pretty complex, we can trace back most of the traits to something called the Big 5 traits of personality. So these are the roots of all of our behaviors. Now, as it turns out, we can also trace back most of our good and bad financial behaviors to these same 5 factors. So let's spend a little time unpacking them. It'll become clear as we chat about them how these factors are important in respect to financial behavior as well. On the left of your screens, you can see a diagram with 5 factors. Each of them are color-coded and linked to an explanation in the same color. Let's go clockwise from 12 o'clock as we start with openness. Now, openness is a dimension of our personality that refers to our impulsivity and spontaneity. So basically how open we are to new experiences, for example. Let's quickly glance over to the right column and match the financial behavior to the blue O for openness. By the way, this is a great trait to have, or at least it sounds like it. And has your partner ever called you out or complimented you on how predictable or spontaneous you are? While this might be a desired relationship trait, though, in terms of financial behavior, it also makes us very present-orientated. So we want to experience now, and of course, if we want to experience now, we don't want to save now. And people with this trait don't mind taking risk as well. So being present-orientated, although it means they don't look at the future as much, they also don't save as much either. If we contrast this to the next trait in light blue, which is conscientiousness, we can see that people with this trait are very aware of their own behavior and the effect of their behavior on others. Conscientious people, however, are not very spontaneous in nature and prefer planning. They are the kids that left the marshmallow on the table, basically, and got 2 back. If we look at the financial behaviors on the right of the diagram matched with the letter C, we can see that these people are generally risk averse, but very future orientated, so savings comes much easier to them. Next, we look at extraversion. These are the life of the party and people that get energy from contact with other human beings. People with low levels of extraversion are the introverts amongst us. Now, this reminds me of a terrible joke, which is not going to stop me from telling it. But as an introvert, I feel like it's my duty to ask, do you know by any chance how many introverts it takes to change a light bulb? Now, the answer, of course, is 5, because the first one in the room will find one of the corners, and the next one will find the next corner, and the next one will find the next corner, until, of course, all the corners are full, which means that the fifth one to enter the room must now remain in the middle to be the furthest away from the others, which, of course, is directly under the light bulb. So it takes 5. Extroverts are quite dominant individuals. Don't mind investment risk and usually have an external locus of control, which refers to having the feeling of having little control over their lives. Next, we talk about agreeableness. These are the listeners amongst us and those who are quite empathetic. They also don't like being away from the herd and place a high value on collective happiness with an internal locus of control. Once again, if we glance over to the letter A on the right, we can see that agreeable people don't mind risk, but prefer it if the behavior matches the herd. Finally, we look at the all-important neuroticism. This trait has been directly linked to pathological behavior, poor relationships, and even poor health from elevated cortisol levels in the bloodstream over time. These are the nail-biters amongst us, who display high levels of anxiety, which of course is related to risk-averse financial behavior as well. At the center of the left diagram, we will note that depending on which traits we possess, this basically equates to human capital we are endowed with. There is extensive research to show that high levels of conscientiousness and low levels of openness, for example, are correlated to higher earnings in life, and even success levels in marriages and friendships. Importantly, there's capabilities that can be built, however, with cognitive behavioral therapy if we're aware of them. So if your kids aren't running around putting away their toys, there is still time for you to change this behavior. You will be rewarded because your kids will earn more later on. We've already seen that our willingness to take a risk is linked to our personality. This is an important link to make because personality by nature has one extremely important characteristic. It is stable. Personality only changes in the event of trauma, but generally everyone knows you as you because of your personality or set of characteristic behaviors. This is important because this is exactly what the industry has gotten so wrong when measuring risk tolerance. Providing things like hypothetical win-loss situations in risk tolerance assessments doesn't measure risk tolerance. It actually measures risk perception. How you perceive risk can change and may also depend on your current emotional state. This is critical because if you measure something that can change and match it to a long-term or static investment goal, at some point you're going to have a very unhappy client. And this has been shown in a number of papers. But on your screen is one piece of research conducted by the CFA Institute. In a nutshell, around the global financial crisis, we can see that the green line clearly dips and then increases with market volatility and then the market recovery. So the percentage invested in the market or risky portfolio dips sharply and then recovers sharply. We can also see that subjective risk expectations represented by the light blue line at the top shows that people are perceiving more and more risk in markets to start with and then much less as markets recover. Lastly, we can see that in general, return expectations shown by the dotted line are growing and growing. But the most important thing about all three of these lines is they are not stable. What doesn't change and is not shown in this diagram is the results of psychometric evaluations done at each point in this timeline. There was virtually no change. People maintained their risk-seeking or risk-averse attitudes throughout the worst financial crisis experienced. Now, when it comes to suitability of an investment in general, we need to make sure we are considering 3 critical things. We're going to ignore required risk for the purposes of this discussion, as this is largely quantitative and straightforward to assess with a cash flow analysis. At the top of the blocks is risk tolerance in pink. This is our attitude towards or willingness to take investment risk. As we've seen, though, this is closely related to our personality, and so this will be a stable attitude. We like risk or we don't like it. If we measure risk tolerance psychometrically, we only need to do it once. Major financial trauma, however, definitely qualifies in terms of a possible change in financial personality and may necessitate another measurement, but this is something we're going to keenly investigate in our further research. So this covers the long term. In the middle of the blocks in green, we have risk capacity or the financial ability to take on investment risk. This is a function to a lesser degree of our income statement and probably to a greater degree of our balance sheet. What kind of financial reserves do we have? How much risk can we afford to take? At the bottom, we have the client's emotional ability to take risk in light blue, or their behavioral capacity. This will depend a lot on risk perception, and so is something that we can change depending on how much risk the person is perceiving in markets. It will also depend on what kind of outcome experience that person has. So how many positive returns versus negative returns they've experienced recently. This is very closely associated with our cognitive and emotional biases. In general, for example, extroverts tend to be overconfident, so they perceive less risk in markets. Of course, there are other factors at play here as well, like the person's degree of financial market experience and knowledge. In a study conducted by Momentum Investments and global decision science experts, Oxford Risk in the UK, we found that there was a lot of noise in the advisor assessment of these three factors. Some advisors would ignore behavioral capacity for risk, where we gave this information in a case study format, while others linked home equity value to risk capacity and others linked risk capacity to income, for example. Others ignored it completely and just weighted risk tolerance much more in the portfolio recommendations they gave. Overall, however, there was a very little correlation between equity allocation and risk tolerance. For each client risk tolerance score from 1 to 7, which was given in the case study, there were recommended equity allocations right from 0% all the way up to 100%, both local and offshore. And this shows there's no consistent mental model of how to apply risk tolerance in advice, and shows clearly that many advisors either don't believe it adds value or are more concerned about other factors that determine investment suitability. To give better advice and ensure better and more consistent investment outcomes for clients, it is important that we start measuring and interpreting things more consistently in the advice process. And our financial personality assessment will provide the ability to psychometrically assess your client's risk tolerance levels and also their likely reaction to market events as well. Before we close off, I'd just like to spend a minute or two reinforcing this relationship between long-term risk preferences or risk tolerance and what happens during market volatility with actual research we've conducted. This is something I put together in my master's thesis, which I built on studying South African investor risk behavior. For the first slide, we just need to establish a baseline for volatility. We may think this is intuitive, but it does help to prove the point we're going to make. If we look at a 3-month moving average of the all-share index returns, we can clearly see 2 periods of high volatility at the beginning and at the end of the timeline. These are labeled A and C. Period A is from June 2008 to December 2010, which captures the global financial crisis and also subsequent market recovery to pre-2008 levels. Period C is from June 2018 until the build-up to the COVID-19 pandemic that started late in 2019. In these 2 periods, the standard deviation of monthly returns is 49% higher than the middle period, which is labeled B. What we then did was to use some machine learning algorithms to analyze over 50,000 investment switches over the same time period. You can see the results on your screens of an archetype we call the avoider. This is a pattern of behavior we picked up where people invest conservatively and then just get stuck in fairly conservative assets in a risk-neutral position. They tend to avoid risk. In the 2 orange squares, however, that correspond with market volatility we saw on the previous slide, we can see that avoiders start behaving erratically. The lines are more jittery in the orange squares. At each point in time, we can see the proportion of avoiders active or making avoider-type switches. In the orange square on the left, we can see that as the global financial crisis affects South Africa, a dramatic increase in the number of avoider-type switches happens. This makes sense as people are avoiding risk. But we can also see that as markets recover, the avoiders start decreasing again, and we can see an increase of avoiders behaving like assertive investors, who are characterized by more aggressive investment behavior and up-risking their portfolios. But what about after the volatility in the period between the orange squares? There is a clear indication that behavior reverts to the mean and avoiders behave like avoiders once more. In fact, overall avoiders behave like avoiders nearly 78% of the time. In other words, the dark blue avoider line is stable overall. They have a long-term risk preference, but as market shocks, it's causing many avoiders to perceive different levels of risk in the market and is separating them from those long-term risk preferences. And that is the key concept of today's session. The key takeaway of today's session is the following. A risk tolerance assessment, which is part of a client's risk profile, needs to measure a stable, long-term attitude towards risk. If we measure this correctly, it will not change, even when markets become volatile. Risk tolerance is the part of your financial personality that refers to the stable attitude towards risk and is measured with a psychometric assessment. Behavioral capacity, however, gives us an indication of how the client is likely to react in market turbulence because of cognitive processing errors or emotional reactions. These are short-term in nature. On your screens, you can see this interplay in action. This is the framework that we've established to tackle South African financial personality. I'm also extremely excited to be working with the University of Pretoria on this one as a part of a multidisciplinary project team with extensive behavioral science, finance and psychology experience to bring you all a world-class instrument that will add tremendous value to your advice conversations. You may also recognize a few of the personality or attitudinal scales like energy direction, for example. This can be traced back to the big 5 trait of extraversion, for example, and you're now all familiar with it. In closing, please also contact myself or Anton Swanepoel to get a copy of the white paper that Anton published recently with the FPI and FIA, to which both myself and 2 of the financial personality team from Tux contributed, and of course many others. This paper provides the platform for tackling the problem of getting more consistency in assessing a client's risk profile and giving even better investment advice. Until next time, it's been a pleasure chatting with you all, and I'll see you all next year to talk about the pilot assessment of this world-class financial personality assessment. Thank you.
Over the last 31 years in the financial services industry, I have witnessed a few common mistakes that financial advisors frequently make at their own expense and at the expense of their clients. In my early years as a financial advisor, I have made some of these mistakes myself. Overselling happens when you position your value proposition as a 24/7 analysis of investment markets globally and immediate crystal ball proactive adjustments to investment portfolios that will prevent losses to the client's investment portfolio. Selling funds is a common practice, which can be detrimental to the trusted advisor-client relationship when the fund that you punted produces poor returns for a year or 2. Even the best funds have had periods of poor performance, and advisors must be careful how they position their proposed investment solutions to their clients. Offering a sound investment strategy instead of selling a particular fund is a far better conversation to have with a client. Then we get to market timing. Trying to time the market is a very dangerous activity that some financial advisors make from time to time. Fund management experts avoid market timing because statistics show that it's simply too risky. And yet some advisors believe that they will be able to succeed. More than 2 decades ago, I tried it and failed dismally. I certainly do not recommend it. Then selling investment returns. When you sell your investment proposal based on the best investment returns, you must remember that you will only keep those clients if you consistently deliver the returns that you have used in your investment proposal. Nobody has ever won that race, simply because of the unpredictable nature of investment markets. And then exaggerating your professional abilities. In August 2013, an academic paper was published titled, "Don't confuse brains with a bull market." The paper dealt with issues such as attribution bias, overconfidence, and trading behavior of individual investors. According to the paper, investors with attribution bias may incorrectly attribute successful, in brackets, lucky investments in a bull market to their own abilities, and therefore they become overconfident. Although the paper was aimed at investors, I've also seen advisors who demonstrate overconfidence in their fund management abilities for the same reasons. I have heard some advisors say, "I have made my clients a 20% return this year." However, those same advisors end up blaming investment markets the next year when there is non-performance or even losses. advisors must be careful when claiming that good returns in a bull market is a result of their professional abilities to pick the right fund managers. It could be a case of confusing brains with a bull market. Underestimating the impact of various events on investment markets is another point. During their conversation with potential clients, many advisors emphasize the need to generate investment returns and underestimate the importance of balancing the conversation with highlighting the potential risks or losses from time to time due to unforeseen events that may have a negative impact on their portfolios. We must always consider the principle of the higher the return, the bigger the risks. This is one of the reasons why the MFP outcomes-based investment and risk profiling philosophy is so important. Then we focus on underestimating client behavior. From experience and conversations with many financial advisors over the years, it is evident that during the initial conversations with investors, it is mostly about investment returns, but the focus quickly turns towards risks, mostly when markets are under pressure. Initially, investors want the best returns, but it is only when their portfolios decline in value that their true sentiment becomes evident. We know that, by comparison, investors experience losses far worse than having a thrill of good returns. Our OBI investment and risk profiling philosophy is aimed at balancing realistic return expectations and being prepared for market volatility. Being able to manage investor expectations before the investment is made and thereafter is arguably one of an advisor's biggest challenge. This is what we are trying to achieve with our OBI investment and risk profiling philosophy. The MFP house view solutions are fully aligned and integrated with an advice-led process that is designed to give our clients every opportunity to achieve their objectives. It includes an analysis of their circumstances, needs, objectives, and comprehensive risk profile. Making recommendations that are appropriate in the circumstances is the primary obligation of advisors. Helping investors to make informed decisions about investments that are designed to meet their needs and objectives is no small task. This is a big enough responsibility in a very onerous regulatory environment, and MFP cannot add an additional responsibility of fund selection to our planners. We strongly believe that portfolio construction, fund selection, and ongoing investment management are the responsibilities of the investment specialists. On behalf of the MFP Exco, we want to categorically state that our collaboration with Momentum Investment Consultants is an MFP initiative and not a product push from Momentum Investment Consulting. The management of MFP is acutely aware that to offer a world-class investment value proposition to our clients, we must offer a best-of-breed investment solution where every stakeholder plays to their strengths, and it is a partnership between MFP and Momentum Investment Consulting. The strength of our financial advisors lies in their ability to engage with clients and do a proper analysis of their circumstances, needs, goals, and risk profile. where the investment specialist's strength lie in the design and ongoing management of investment portfolios. That is the combined value proposition of every leading wealth management business in the world. This slide represents the MFP planning OBI philosophy and the various house view solutions as discussed during the presentation that are constructed by investment specialists to complement your advice. The MFP Exco is confident that these portfolios, as highlighted today, will contribute significantly towards meeting clients' outcomes over the specific investment terms. The MFP Investment Committee and the MFP Exco support these investment portfolios 100%. This slide represents our global house view, which is also consistent with our OBI philosophy. And the MFP Investment Committee and Exco also fully support these solutions. The global cautious, managed and growth solutions are specifically designed to support your clients' short, medium and long-term investment objectives from a global investment perspective. Colleagues, I sincerely hope that you can see that the MFP House View solutions are there to support your advice-led value proposition to your clients. The MFP Investment Committee has entered into this partnership to enhance the probability of your clients to meet their investment objectives if they stick with the OBI strategy, whilst at the same time reducing your risk and Momentum's advice risk at the same time. Together, we will definitely be stronger in serving your clients. Thank you very much for attending today's session.